Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist at Wealth Press. Today is Monday. It's December 12th. December is almost halfway behind us, and it's about 7:56 in the morning. The market's going to gear up to open about an hour and 34 minutes to be as specific as I can with you. Welcome to a new trading week. This is the third trading week, theoretically. Well, we're on the 12th, so we're starting the third trading week in December. And I hate to say I told you so, but remember I said last week wasn't going to be pretty? Well, it was one of the nastiest week of the year, and we'll get into that. Now, the market's opening higher today. The fact that the markets are opening higher is not a good sign. Typically, in a bearish rout, you will see higher openings and lower closings. So the fact that we're a little higher today is not a big deal, especially when you're only up 60 points after the downside that we've seen. Now, volatility levels, as I mentioned to you, are now higher. Volatility levels are now at the highest level in about roughly a month. It's about 11:15 here. So let's take a look here. I'm ballparking it here, but somewhere around the highest level. Yeah, somewhere around the highest level of the month, or near 1 month high. And I warned you that this was going to go higher, and I expect it to continue moving higher. Also, folks, this is important. Pay attention. We've got a huge week on the table. Before I get into what happened last week and what's on the table, we've got the CPI tomorrow. Now, the PPI did not come out as what the PPI still came out showing that inflation is hovering. It's not slowing down nearly as well as the Fed has hoped. So that's putting a bearish sentiment on the market. But we do have the CPI, which is the consumer price index, not the producer's price index. And what we're looking for, I'm going to tell you right now, we're looking for this number. First of all, forget month over month. Forget about it. And the whole enchilada, well, that's going to be important. But here's the crux of it right here. That's the big crux of the report. And this is what we're looking at. We're looking for this number to be below 6.1. Hope now, if it's at 6.3 or 6.4, ouch. But if it's 6.1, that's telling us that what they're doing is being effective. And I'll go through this tomorrow before the opening as well, but something you need to pay attention to. But this week, just to give you an idea, oh boy, you've got CPI, you've got the FOMC and the Fed announcement tomorrow, where the Fed will more likely than not raise rates half a basis points, which is well priced into this market. More importantly, his forward-looking comments. Is he going to continue saying it's working, there's a lag, we're going to keep pressing on? I want to see what he says. I want to see how stupid he sounds. Because he can get really dumb sometimes. If you listen back to the things he says, he's just all over the place. I'm not a big fan of Mr. Jerome. I'm going to wait and be honest with you after I get reappointed Powell, as you guys know. But then on Thursday, oh boy, we got industrial production, we got retail sales, which makes up 2/3 of the economy, and you've got jobless claim, and you've got the manufacturing index, and then you've got the PMI. So tomorrow, Wednesday, oh boy, tomorrow, Tuesday, Wednesday, and Thursday are going to be monumental days. I do not see volatility going down. As far as the bond market, let me just kind of give you an idea of what the bond market's doing, and I'll get into the nitty gritty. And the bond market, I want to show you, appears like it's moving higher. But when you take another look at it, you'll see that it looks like it's actually peaking out right below the 200-day moving average, which is very typical and common. And also, it's grossly overbought and coming down. So I'm expecting more downside from the bond market. Now let's talk a little bit about global economy and talk about the nitty gritty and what to expect, and give you guys a little update, and then I'll get into the technicals. I love my Mondays. Mondays are an exciting day. Notching their biggest weekly drop in more than a month. Again, I'm going to repeat that. Biggest weekly drop in more than a month. I told you it would happen. As hotter than anticipated U.S. producers' price data stoked investors' jitters. Who writes this stuff? And the Federal Reserve would keep interest rates higher for longer to cool persistent inflation. I mean, people are I'm going to say the short-term memory in this market is shorter than I've ever seen in history. The U.S. producers' price index rose slightly more than anticipated, and an increase in cost of services. With this inflation, that's not pretty. However, the data pointed to slowing inflation, with annual inflation at the factory gate posting its smallest growth in 1.5 years. That's something. At the same time, the University of Michigan survey showed that consumer sentiment improved in December, while inflation expectations dropped to a 15-month low. I think that's a big mistake. I don't think we're out of the woodwork just yet. There's almost a 75% chance of a 50-point basis hike, which is what I think the Fed will do, and that's baked into the market, and about a 25% chance of 75. And I told you last week that this number will probably go up to about 25%. If we continue seeing bearish bias going into tomorrow, that number may increase. But I think right now it's fair to say that we have about a 75% chance of seeing 0.50 versus a 25% chance of seeing 0.750. Now, I'm not getting excited about this because this is still twice the usual. Today, we're going to focus on the U.S. federal budget balance. Economists forecast that the balance will stand at $248 billion compared to a previous value of $88 billion. Yeah, thanks. The economy is definitely picking up, folks. Our balance is at $248 billion instead of $88 billion. I mean, you can't make this up if you try. In Eurex, stocks are down slightly, digesting fresh UK data while awaiting series of central bank policy decisions this week, as I just mentioned. The UK gross domestic product grew by 0.5% in October, stronger than expectation of 0.4%. Not really anything huge. At the same time, Bank of England expects the GDP to contract by 0.3%. Also, central banks warned that the country is facing longest recession since record began, with the economic downturn expected to extend well into 2024. Now, folks, I want you to understand, the economy right now is very global. So if they're expecting a major downturn, that will impact U.S. economy. The Shanghai Composite closed lower as market participants feared that the easing of anti-COVID measures in China would result in a much higher infection rate. You just can't win with China. The dampening recent optimism over a potential economic recovery with the withdrawal of COVID restrictions. At the same time, the Japan index went lower after data revealed that producers' price index, similar to what we saw here, remained near a 40-year high. So Japan is not doing all that great. We have Oracle earnings today. That's a huge company for networks and tech, and Coupa Software for info technology. Now, looking at the stock, I want you guys to see something here. If you're looking at the 20-day breakdowns, the number's now 161. As I mentioned, we don't bottom out till we get well into the 500-600, especially to the downside, and only 31 stocks making 20-day breakouts. So there's definitely a sentiment towards the bears right now. If you look at the modified CSI, which we extended to because we used to use 6-month, 3-month, 1 month, we switched to 12-month, 10-month, 8 months because the signals are much more stable. We back tested this over the years, and we're still showing bullish energy stocks. And now, if you go to the shorter term, which I'll show you right now, it's totally different. It's showing Ross Store, Las Vegas, Gillian, Boeing, air producer, Starbucks, going out stocks. I don't think we're anywhere near there right now, and I think that's a pullback against the trend. And as a matter of fact, I want to show you something else. If we go back there, you'll see, let's just go to this filter. You'll see that most of these stocks, even though they're higher, like look at Etsy, for example. It's showing higher highs, right? But look at where it is. Or look at Gap. It's showing like it's breaking out, right? But look at the major trend. So although these stocks look like they're making 6-month and 3-month highs, when you look at the long-term trend, they're simply pulling back. But when you look at these stocks right here, and like look at Oxy, look at the long-term trend. Much different. It looks like we're still near the highs, not a downtrend that's moving higher. So again, we got to be very cautious. Now, looking at each individual sector, which we will do right now, let's go there right here. Healthcare, industrial, basic material, consumer staples. Utilities is even higher than energies. But if you look at energies, which we will look at right now, I want to show you guys something. Don't rule energy out just yet. If you look at energy right now, you will see that energy is oversold, just like it was right here. It's hitting towards the 200-day moving average. We're still in an inflationary environment. It happened right here. It happened right here. And it looks like it's happening again right here. Folks, to me, this looks like a major pullback, not a sell-off. We're still in an inflationary environment. We're nowhere near done with the war. And typically, energies stay higher when we have this type of an economy. So I wouldn't rule energies out just yet. I think this is a downside because economic data got better in the short term. But if you look at stocks, if you look at the Dow, stocks trading above the 50-day moving average, We're not at 95th percentile anymore. We're at 82nd percentile. And when you look at market momentum as a whole, only 56% of stocks are trading above the 50-day moving average, and 40% of stocks are trading above the 200-day moving average. So I wouldn't be falling for this, folks. That is a red herring right there. And if you look at all the sectors, notice how much more. Notice we have 13, 70. These numbers are cooling off. And notice the 200-day. They're not above. They're 48%, 44%, 19%, 32%. Cracks in the foundation. But with that said, I want to show you guys energy. Check this out. Wait. Look at energy, how overdone it is right now. So I personally think, look at that. So I wouldn't be a seller of energy right now. I wouldn't be fading energy. If energy looks like it's ready to bottom out and start going a little higher. So I'm anticipating higher prices for energy. And I would recommend that you guys stay defensive. Healthcare, industrial, basic material, consumer staples, and let's see energy come back up. I would not touch technology, consumer discretionary, communication services right now at all. Now remember, folks, you've got a lot of major Fed data next week. A lot of real major Fed data next week. So we've got to be really cautious. Now, before I let you go, do you guys want the 3 top tickers to kick off the week? I bet you do. The names of the stocks the champion indicator is signaling are setting up for a move, folks. Well, that makes sure to click on the link below, register your email for today's event, and watch the training you're taken to after you enter the email. That's the best way. That's the best way to get ready for the live reveal today at 1 p.m. Eastern Time. You'll get the names of the 3 stocks that look ready to make a big move. Oh, yeah. And how we would trade them. Follow the link below. And if you're watching on YouTube, remember, it's the Wealth Press YouTube channel. Remember, register for the email for today's event. Watch the training that you're taken to after you enter your email. Follow the link below, and I'll talk to you guys soon. Bye, guys. Take care and have a great day.